Zions Bancorporation, ticker Zion. Second quarter 2026, diluted EPS, a staggering $3.05. Net earnings, $452 million. Net interest income, $677 million.
And looking ahead to Q2 2027, the forward guidance is pointing to moderately increasing net interest income and, solid commercial loan growth.
Right. So if you're an investor parsing through regional bank earnings right now, trying to figure out where the sector is actually heading, a massive $3 earnings per share figure just jumps right off the screen.
Oh, absolutely. It completely derails your expectations.
Yeah. So our mission in this deep dive is to look past that incredible headline beat and, figure out exactly how the core banking engine is actually performing under the hood.
Because in the banking sector, the headline number almost never tells the complete story. I mean, you have to strip away the one-time events, the accounting noise, and all those macro fluctuations to find the actual operating leverage of the business.
Yeah, and I want to start right there with that noise. Because if you're an investor looking at an 87% EPS jump year over year, meaning they went from $1.63 in the same quarter last year all the way up to $3.05,
Right.
you kind of have to be skeptical.
Right. You should be.
I see a number like that, and I immediately wonder, is this a permanent structural step up in profitability?
Yeah.
Or did management just, find a $100 bill in their winter coat?
In this specific quarter, it is heavily weighted toward the winter coat.
Okay.
Yeah, we need to deconstruct what management actually labels in the report as notable items. So the single biggest driver of that $3.05 headline EPS was a $215 million gain on the sale of Visa Class B1 shares.
So they basically just cashed in some stock they were holding.
Exactly. They monetized a legacy asset. And that single transaction added $1.12 per share directly to the bottom line. Yeah. It's a fantastic windfall, but it is definitely not a recurring banking operation. And then you have a second notable item kind of buried in the footnotes, a $37 million net unrealized gain driven by valuation adjustments in their SBIC investment portfolio.
Okay, let me just stop you there because we see this acronym pop up in regional bank earnings literally all the time, SBIC. What actually is that? And I guess, why does a bank hold those investments if they create this kind of wild earnings volatility?
So SBIC stands for Small Business Investment Company. These are privately owned investment funds that are licensed and regulated by the Small Business Administration.
Right.
And banks invest in them because it allows them to essentially provide venture capital and private equity to small growing businesses in their footprint.
Oh, which probably satisfies some regulatory stuff, right?
Exactly. It often satisfies requirements like the Community Reinvestment Act. But because these are equity investments in private companies, their valuations just fluctuate.
Meaning the bank has to mark the value of that portfolio up or down on paper, even if they haven't actually sold anything.
Precisely. It's paper gains. In this quarter, they recorded $44 million in unrealized gains, minus a $7 million success fee accrual, which nets out to a positive impact of 19 cents per share.
Okay.
So again, great news for the book value, but it really doesn't tell us how many loans they originated or, deposits they gathered.
Right. Let's run the math on the core engine then. So we take the 305 headline.
Yep.
We strip out the $1.12 from the Visa sale, and we strip out the 19-cent paper gain from the SBIC portfolio. So that brings us down to, what is that, an adjusted EPS of $1.74?
Yeah, $1.74. And that is the number investors really need to focus on. But I will say, taking away the found money shouldn't detract from the reality of the quarter.
Right, but it's still good.
It's very good. That adjusted EPS of $1.74 represents a 10% increase from the $1.58 adjusted EPS they reported in the exact same quarter last year.
See, and a 10% increase in core profitability is a really strong signal of organic growth.
Yeah.
Like the sugar high wears off, but the actual diet is still fundamentally healthy.
Absolutely.
But I want to understand how they achieved that 10% core growth. Because we need to move from the income statement over to the underlying balance sheet mechanics. And this is where I am, frankly, a bit confused by their funding situation.
How so?
Well, I'm looking at the broader banking environment right now, and rate pressures are literally everywhere.
Oh, yeah.
Customers are smart, right? They're constantly moving cash around, looking for higher yield. Consequently, the cost of deposits is just not getting cheaper. And Zions' total funding costs crept up another basis point sequentially to 1.69%. So if their funding costs are drifting up, How on earth is their net interest margin staying flat sequentially at 3.27%? And actually not just flat, but up from 3.17% a year ago.
Wow.
It feels like those margins should be compressing hard.
It completely comes down to the asset liability dance, and they are executing it incredibly well on the asset side.
Okay.
To understand why the margin isn't shrinking despite those rising funding costs, you really have to look at what they are doing with the money they lend out. The yield they are generating on their average loans is currently sitting at a very healthy 5.61%.
Ah, so they're essentially just passing those higher funding costs straight along to the borrowers.
They're managing the spread, yeah. The net yield on average loans and leases only decreased slightly, and the yield on their average interest-earning assets net of hedging was 4.90%. But here's the thing. They aren't just relying on loan yields to defend their margin.
Right. There's fee income, too.
Exactly. We have to factor in fee income. They grew their customer-related non-interest income by 11% year over year, which brought it up to $182 million.
Which means things like wealth management fees, treasury management, maybe capital markets activities.
Mostly capital markets and wealth management in this specific quarter, yeah. And that organic growth in fee income provides this critical buffer. I mean, it is revenue that doesn't require the bank to take on additional interest rate risk or tie up balance sheet capital in the same way a traditional loan does.
So let's talk about the deposit side then, because banks have been fighting tooth and nail for liquidity lately. We have seen their peers bleeding cash to like 5% money market funds.
Yeah.
Did Zions lose ground on their deposit base while they were trying to maintain that margin?
They actually grew.
Really?
Yeah. Period-end customer deposits grew 4% year over year to $72.7 billion.
Wait, how are they pulling that off? If literally everyone is chasing yield, how does a regional bank organically grow its deposit base by 4% without jacking up the rates they pay so high that it just destroys their profitability?
It comes down to the type of deposits they are gathering. Zions is heavily focused on middle market commercial banking. So when you are the primary bank for, say, a mid-sized manufacturing company, that company isn't just parking cash in a high-yield savings account. They are using you for payroll processing, treasury management, daily operating accounts.
Right. The cash literally have to be there to run the business.
Exactly. Those operating accounts are incredibly sticky.
Yeah.
The business isn't going to uproot and move its entire payroll operation across the street just to chase an extra 20 basis points of yield on their cash.
That makes total sense.
And that 4% growth in these core customer deposits gave Zions a massive strategic advantage this quarter. I mean, it gave them the liquidity they needed to aggressively slash their wholesale funding.
And wholesale funding being the really expensive money banks borrow from institutions when they just don't have enough retail deposits to fund their loans, right?
Right. Specifically, they took their short-term borrowings down by a massive 79% compared to the prior year.
Wow.
We are talking about a $4.6 billion reduction in short-term debt, driven primarily by a decrease in Federal Home Loan Bank, or FHLB, advances.
Let's clarify FHLB for a second, because the Federal Home Loan Bank system acts as a sort of like liquidity backstop for the banking sector.
Mm-hmm.
During the whole regional banking crisis, we saw banks tapping the FHLB for billions just to stay afloat. But that money is not cheap at all, is it?
Oh, it is very expensive compared to a standard checking or savings account.
Mm.
Banks use FHLB advances when they absolutely need liquidity, but they hate relying on them long-term because that high interest rate eats directly into the net interest margin.
Right.
So by organically growing their core customer deposits by $2.5 billion, Zions was able to just pay off $4.6 billion of that really expensive FHLB debt.
So they swap out the expensive institutional borrowing for cheaper, stickier commercial deposits.
Mm-hmm.
It makes perfect sense. The total cost of deposits came in at 1.48%, and when you blend that 1.48% cost with the 5.61% loan yield we talked about, you get that really stable 3.27% margin.
You do. But you also have to consider the operational cost required to generate that margin in the first place.
Fair point.
Their efficiency ratio remained completely stable at 62.2%, which matches where it was a year ago, and it actually improved from 65.0% in the previous quarter.
Which means it cost them roughly 62 cents to generate $1 of revenue. Though I did notice their adjusted non-interest expenses actually rose by 5%, or $25 million year over year.
Yeah, the expenses did go up.
Yeah.
The primary drivers there were higher professional and legal services, which rose by 9 million. Salary expenses were up 8 million, and technology investments were up 7 million.
Okay, pretty standard inflation stuff.
Yeah, but because they grew their tax equivalent net interest income by 4% and their fee income by 10%, the revenue growth simply outpaced the rising costs.
The operating leverage held up. Okay, so we have stable funding, we have growing fee income, and controlled operating costs. That paints a really great picture of the core engine. But we cannot evaluate a regional bank's balance sheet right now without staring down the absolute elephant in the room, which is loan risk.
Oh, for sure.
Specifically, commercial real estate, or CRE.
It is the single biggest fear factor for bank investors right now, without a doubt.
Yeah, and looking at the charts tracking CRE growth across the banking sector over the last decade, it's almost like Zions was the designated driver at a regional bank party where everyone else was just gorging on commercial real estate debt.
Right.
They just sat in the corner drinking water.
Yeah.
And now they seem to be the only ones not dealing with a massive hangover. But are their credit metrics actually as clean as they look?
They really are, and management explicitly noted in this report that Zions intentionally lagged peer CRE growth for over a decade.
They did it on purpose.
Completely on purpose. They exercised intense caution regarding CRE concentrations and maintained really strict underwriting standards while other banks were aggressively chasing yield in that space. The result of those disciplined decisions made 5 or 10 years ago is showing up right now.
So let's hear the numbers.
Annualized net charge-offs, which are loans they have actually written off as uncollectible, are sitting at just 0.06% of average loans.
Wow.
Yeah, that is actually down from 0.07% last year. It places Zions firmly in the best, meaning the lowest quartile of their peer group.
Charge-offs are backwards looking though, right?
Yeah.
What about the forward-looking metrics, like loans that are just starting to show stress?
Also looking good. Non-performing assets, so loans that are in default or extremely close to it, also ticked down to 0.48% of total loans and leases.
Okay.
And classified loans, which is the broader category of loans signaling potential weakness, dropped significantly to 3.72% of total loans, down from 4.43% a year ago.
So the credit quality is genuinely improving in an environment where a lot of their peers are seeing severe deterioration. But let's zero in on the exact composition of that CRE portfolio, because not all commercial real estate is created equal right now.
No, definitely not.
Like a warehouse in a good logistics hub is totally fine. Office space is the toxic asset everyone is terrified of.
Office is where the pain is concentrated, absolutely. And this is where Zion's lack of tail risk becomes incredibly apparent. Office loans make up only 13% of their CRE term balance.
It is a very small slice of the pie.
And it gets better when you look at the collateral backing those specific loans. Their office portfolio has a highly conservative weighted average loan-to-value, or LTV, of 57%.
I want to make sure the mechanics of that are crystal clear for you listening, because it perfectly explains how a bank survives a real estate crash. If Zions issued a loan on a downtown office building, an LTV of 57% means the loan only represents 57% of that building's appraised value at origination.
Right, meaning the borrower put up 43% equity in the project.
Right. So if the commercial real estate market tanks and the value of that specific office building drops by 20%, 30%, or even 40%, Zions is still fully covered by the physical collateral. The borrower might lose their entire equity stake, but the bank can just sell the building and recover its principal.
Exactly. That is the protective mechanism of strict underwriting. When problems do arise, Zions generally experiences much less severe loan losses precisely because of that massive equity cushion. And you can see management's confidence in this specific portfolio reflected in their provision for credit losses this quarter.
Right. How much did they set aside?
They only provisioned $3 million.
$3 million. For a bank with a $62 billion total loan portfolio, a $3 million provision is basically a rounding error.
It really is.
It signals they view the portfolio as exceptionally healthy.
Furthermore, their overall allowance for credit losses actually decreased year over year from $732 million to $707 million, which represents 1.13% of total loans.
Wow.
Management explicitly stated that decrease reflects lower reserves associated with CRE portfolio-specific risks. They simply do not see the storm clouds that other regional banks are furiously bracing for.
Which brings us to the final piece of the puzzle for investors' capital allocation. We've established that the credit is clean and core earnings are growing. So what is management doing with the cash they are generating, and what are they signaling for the future?
We have to look at the Fortress balance sheet. Their Common Equity Tier 1, or CET1 ratio, which is the primary regulatory measure of a bank's financial strength and core capital, strengthened to 11.0% a year ago.
And their tangible book value per share surged 22% year over year to $44.74.
Yeah, that massive jump in tangible book value was driven by two primary factors: strong retained earnings from their core operations and a substantial reduction in unrealized losses within their AOCI.
Let's talk about AOCI, accumulated other comprehensive income or loss. This has been the ghost haunting bank investors ever since the regional banking crisis of 2023.
Oh, absolutely.
When interest rates spiked incredibly fast, the long-term fixed-rate bonds that banks held on their balance sheets lost market value. It created these massive unrealized losses on paper.
Yeah, and at the end of June 2026, Zion's AOCI balance still reflected a net loss of $1.9 billion.
Okay?
This includes $1.5 billion of unrealized losses tied to securities they previously transferred from available for sale to held-to-maturity categories.
So they are sitting on a $1.9 billion paper loss.
Yes. But here's the critical mechanical shift to understand. As those bonds inch closer and closer to their maturity dates, those paper losses naturally amortize and vanish. The bond pulls to par.
It's like an iceberg slowly melting to reveal the dry land underneath. The bank doesn't have to do anything except let the clock tick.
I like that analogy. The industry calls it the AOCI burn down.
Burn down.
Yeah, and Zions is projecting their AOCI to improve by $239 million, or 12%, in 2026 relative to 2025. All else being equal, that natural passive burn down will organically add 25 basis points to their tangible common equity ratio in 2026 alone.
So they are literally building capital just by waiting.
Basically. Plus, they noted their hedging strategy provides meaningful protection against term rate volatility moving forward, assuming the forward interest rate curve holds steady. So because they have this expanding capital base driven by core earnings and the melting AOCI iceberg, they can confidently return capital directly to shareholders.
Right. And they executed a $75 million share repurchase this quarter, buying back 1.2 million shares.
That is the ultimate signal from management. I mean, you do not buy back your own stock if you are secretly worried about impending commercial loan losses eating into your capital reserves.
It shows total conviction, and that confidence extends to their forward outlook. Looking out to the second quarter of 2027, management expects moderately increasing net interest income. On the loan side, they're forecasting moderate increases in commercial loans, specifically commercial and industrial, and owner-occupied real estate, which will drive overall loan growth.
Right, followed closely by conservative growth in commercial real estate. Meanwhile, they expect consumer loans to contract slightly.
Which means they're clearly leaning heavily into their identity as a commercial lender, which makes total sense given the source material specifically highlights that Zions recently ranked 7th among all U.S. banks for middle market and small business banking, pulling in 15 Greenwich Best Bank Awards. They are a dominant player in that specific middle market commercial space.
They are, but, and this is a big but, that brings us to the broader strategic horizon.
We've painted a picture of a bank that has brilliantly played defense. They sat out the riskiest parts of the CRE boom. They protected their deposit base by focusing on sticky operating accounts. They organically grew fee income, and they have pristine credit quality. It sounds flawless.
Right.
But in the forward-looking statements and risks section of this earnings release, management explicitly flags a growing structural competitive threat.
Yes. They point directly to the growing market presence of credit unions, financial technology companies, and other emerging competitors. Specifically, they highlight non-depository financial institutions, or NDFIs.
Right, so private credit and business development companies.
Exactly. Private credit has been aggressively expanding its footprint.
And this is the strategic question you have to ponder as an investor looking at Zions today. If you look at the macro charts tracking the growth of NDFIs, their concentration as a percentage of total corporate loans has absolutely skyrocketed compared to traditional regulated banks.
Oh,
These alternative lenders are aggressively pushing into the exact middle market spaces that traditional banks are slowly vacating due to heavy regulatory capital pressures.
it creates a fascinating tension for the future. Zions has thrived over the last decade by being the disciplined, cautious, highly conservative underwriter. But as private credit steps into the middle market, offering faster execution, looser covenants, and significantly more leverage to borrowers, does that historical discipline become a hurdle?
That's the million-dollar question. Will Zion's highly disciplined, cautious underwriting model, the very thing that brilliantly protected them from the commercial real estate hangover today, will become a competitive disadvantage in the battle for future commercial loan growth against these unregulated NDFIs? It's a rapidly shifting financial landscape, and it's the vital narrative you have to watch underneath these massive headline numbers. Follow the show for daily earnings coverage.